Thank you. It's great to be here. I'm going to get my phone out of the way so I don't, it doesn't ring and I try to answer it while I'm here. So we got a lot of exciting things to talk about today. I might warn you, I was telling some of the staff here earlier, from the Hill staff that were talking to me, they said, well, you got to keep these guys awake after lunch. I said, you know, I'm going to just warn them, because one of the first speeches that I ever did when I started in this business, it was a cold day out, I was in Wisconsin, it was dairymen, there was a couple of dairymen there. The guy sat right down in front, and as soon as I started talking, he fell asleep and started snoring. I mean, it was loud, it was like, I'm going to mutter through this and get this thing done. Turns out he was the only guy that opened an account with me from that group. So, just be a warning. If you fall asleep, you could be opening an account and not even know about it. So, to get started today, we want to talk about a few things here. We want to talk about, well, first of all, we got the disclaimer, keep the NFA and CFTC happy. And if you got good glasses and can read fast, you probably can read that. But the thing that we want to talk about today is a broad view. What's the market driving? And I'm sure a lot of you got figured out and are following the markets and you're saying, well, the corn market's going up because it should, because there's no corn and so forth. But we want to talk about a couple of things that do affect the market. And we'll talk about them in broad terms, like money flow. You've heard that word before. Then we're going to talk about supply and demand. Two different things that affect where prices go over a period of time and what might cause price movement. So this chart is just a graph, and it's a graph of the stock market. And you can see well, you can mostly see the line because I get a hard time reading the numbers at the bottom of this view, but basically 2009 to current date, we've had a bull market in the stock market. The black line is the commodity price index, and that includes energies, grains, gold, silver, and so forth. And you can see it's been down. Money flow has been going into the stock market rather than into the commodity market. This chart is a graph of energy. You can see how energy prices bottomed a few years ago. Now we're kind of working higher as we move forward here. And energy prices is a big part of that commodity price index. So it's not all about corn and soybeans and wheat. This is a chart of the grains. Just giving, and the reason I'm showing this is to give you a view of where we've been. Grain prices, of course, since 2009, 10, 12 area, we had a nice rally in grain. Since that time, we've been down. And you can see they're all kind of bunched together in a sideways trading range right now. So that is certainly a factor that we need to pay attention to. But money flow, I think, is the most important, one of the very important things. I don't know if it's the most important, but it's very important when we try to decide where prices go and to justify prices. This graph is a picture of managed money. The dark portion, the top portion, is the portion of managed money that is managed by systems, algorithms, system trading. Basically, to sum it up, when the trend is up, they're all jumping on it, and they continue to jump on the upside or the trend as long as they possibly can. And then when the trend changes, they jump off the boat and the market goes up and down. That creates a lot of volatility in our markets. We've seen that volatility recently in the cattle market. The cattle market is certainly an example of trend and money flow and volatility, because the trend starts going up and you say, why is the cattle market going up or it's going down? There's no reason for it other than money flow. The system traders are getting out, or getting short, or they're getting long. They don't care which way they go. This chart, I think, is the really important thing for you to look at, is because that red line that runs across the top of the chart is the actual amount of money of the total managed money picture. That small portion is the amount of money that's traded by only agricultural traders or agricultural funds. So it's really a small portion of the whole pie. But the blue area is the diversified. They'll jump from one commodity to the next. So that's the biggest chunk of the managed money industry. And I'm telling you this because when you got somebody finding a trend and following it, it's going to take a market higher than it should, more likely, and it's going to take it lower than it should. This money, this diversified money, you hear about money flow, and when the market is going up and you've got the prices are moving higher, it's called smart money. When the market is going down and pushing prices lower, they call it funny money. Imagine that. When it's going in our favor, going up, we're calling that smart money. So that, and then sometimes just called hot money. However you want to describe it, it's money flow. It's a massive amount of money. We're talking $300 billion of money that comes into the market, and once it gets behind a certain trend, it takes the trend a long way. Like we're seeing in the stock market right now. We've had a bit of a setback. Analysts, economists still believe that the stock market can trade 27,000 this year. I don't know if it can or not, but the money, the big money, is still in an uptrend, and therefore it continues to push it. We'll talk a little bit about agriculture here later. This is when you talk about agricultural money, or money funds, I should say, that are in agricultural futures only, it's only about $1.5 to $2 billion. Not a very large amount of money when it comes to that big picture of $300 billion. So, and you can see that money hasn't changed a lot, but it's the diversified money that makes a big difference. This is the chart to just give you an example here of the index funds. You hear about index funds, you hear about Goldman Roll. Goldman Roll is happening right now, which means that they're normally long the market, they're only long the market, but they're selling right now between the 5th trading day and the 10th trading day of the month prior to the contract. So for April contracts of livestock at this point in time, cattle and hogs, they're rolling out of their long Aprils and going to a deferred contract. Sometimes they'll go to the next trading month, sometimes they'll go to a more deferred month. But they are always long the market. So they're always on your side to help drive prices up. And what we've seen in that big bump in 2009 and 10, that's when we've seen a lot of funds all over the world jump on the agricultural wagon, and they have EFT markets and exchange traded futures contracts, and everybody was developing those, and that's helped push that long position up. And then once they got accused of driving grain prices too high that people in the world couldn't eat, they said, I'm out, not doing it anymore. So now you see a very stable trend in the exchange traded funds and in the index. Goldman Sachs is one. There's several of them that are rather large funds, but they're always rolling out of these nearby contracts and then moving to the deferred. They do that usually at a very publicized time throughout the month. So we got to be aware of that as we're trading and pricing our markets and our products as well. Managed funds. You've probably heard about this. If you haven't, you need to pay attention to it. CFTC puts out a report every Friday afternoon about 2:30, and they tell you how many managed, or they give you a report on commodity funds and and what are their net positions. Are they net long, are they net short? And that will keep, and the trade looks at that and says, well, the funds are going long now, so let's jump on that wagon. And that's what we've seen over the last several months. This chart, well, it's hard to see, but far to your right of this chart, we had a very large short position, over 400, almost 450,000 contracts net short by the funds in the three major commodities, corn, soybeans, and wheat. And today, which is roughly 2 months later, and as of Tuesday, and these totals are calculated as of Tuesday night closes. So we'll get a report tomorrow afternoon telling us what the net fund position is. As of last Friday, they were now net long over almost 200,000 contracts. So in 2 months, they went from 450,000 net short to 200,000 net long. So that money flow has changed. What has kept prices higher? It's money flow. The money, the funds, and outside influences have driven prices up. And the question is that we ask every day, and that we get asked every day, is how much higher does prices go because of money flow? Well, you can see that if you get up to 200, 300, or 400,000, you're getting at the high end of the range of what funds usually have and usually hold as a net long position or net short position. So we went from record lows to near the highs within 2 months. Something to pay attention to. So when you summarizing the fund picture, the money flow is extremely important to figuring out where the market's going. If the market is oversold, let's say, its funds are very short, you probably don't want to force the position to the downside. And that's what, when we talk to producers, it's like, you know, you hear all the negative rhetoric at that time, and you say, well, why isn't the market going to go a lot lower? Everybody's bearish at the bottom. Well, things have a tendency to change. And that's the thing that I wanted to share today also. When you look at prices, you say, well, where's prices been a year ago? The prices a year ago, in early March, for November soybeans was, I put it here, I got it somewhere. We were 10.35 a year ago on November soybeans. Today in November soybeans, we're at 10.47. And when we get into supply and demand, you're going to scratch your head and say, why in the world are we at the same price we were a year ago when we've got almost twice as much carryout as we did a year ago? So is the supply and demand the factor, or is it really the money flow? The other thing that you have to remember that a year ago, and many times when you're following the funds, they have a tendency of buying until the first part of March, and then for some reason they decide to turn sellers. So they haven't done that yet, but let's be aware of it. So when we look at supply now, we look at how many beans do we have in the world, how many beans do we have in the U.S. We've got almost, the USDA just came out with a report at 11 o'clock this morning on the supply and demand report, and they say that we have got they're expecting to have 555 million bushel of soybeans left at the end of the year. We're going to have plenty of supply. Last month they said we were going to have 530 million bushel. And we've got so we increased 25 million bushel in our ending stocks. And what did soybean prices do today? Basically unchanged. So you've got to think it's certainly not supply that's driving the market. It's probably money flow still that's involved in the marketplace. But those are factors that you have to monitor when you're trying to decide where do you market grain today, market it tomorrow, what should I do? So we've got to keep our handle on that. Supply, when you look at U.S. supply of soybeans, our supply is plentiful. Our demand is not as great, as shown by this chart. Our supply continues to outgrow the demand at this point in time. Because a lot of our beans are exported, and where did they take the increase from, or the demand side of the equation here on soybeans? They took it away from exports today. South American production, another topic that gets is getting all the attention. It's not raining in Argentina. Everybody believes that the Argentina crop is going to go to zero now. Like wheat, how many of you have felt that way in years when we had drought? How many felt that way a year ago? I mean, it was very difficult to market grain in corn, soybeans when you had a very dry condition. Prices were at good enough levels that I got a good crop, but I couldn't do it because I didn't know if I was going to have a good crop. And here it turned out it rained at the right time, it was cool, and ended up with a very robust crop after all. Will that happen in Argentina? It remains to be seen. They're growing the same kind of crops that we are, and there's areas there. I was on a chat this morning listening to a comment from a producer in Argentina. He says that there are certain areas that are doing very well, certain areas that are very, very dry. But it's a matter of rain. They're in the production phase of their agriculture crops right now that very similar to August for us. If we got rain in August, our soybeans would do very, very well. Could do better, and it would change the whole outlook. And that's where we're at in Argentina. The projections right now, well, the USDA came out with their numbers. They lowered the Argentina corn crop to 36 million metric tons versus 39 million last month. They've changed the soybean crop. They went down to 47 million metric tons versus 54. Now the trade was looking for about 48, so pretty much in line. Nothing really out of line there. The biggest question is how much will Brazil make up for it? Now the USDA raised Brazil's production of soybeans by 1 million metric tons, so up to 13, very close to their record production they had last year. And our people, R.J. O'Brien, the clearing firm, they've got people in Brazil. They're saying that with the conditions they've got down there and some of the harvest that has already been done, they expect to see more than 115 million metric tons come out of Brazil. So Brazil will probably offset some of these losses in the Argentina area. This chart, the far to the right, shows what Allendale expects out of Argentina. We're thinking maybe a 48.5 is still possible out of Argentina. Brazil, 115. There's also guys in Brazil right now that we talk to. They think we could have a 119 crop out of Brazil, and not because the crop is going to be that much bigger throughout the whole area, is they planted a lot more soybeans this year than they did last year. So with the extra acres, extra hectares of soybeans, and the good yields, it's very possible that you can see a larger number come out of Brazil. So it may not be as big of an influence as expected. Another thing that happens in Brazil and Argentina, everybody's looking at this carryout that we have, this 555 million bushel right now, using the reduction in Argentina's crop, that all of that soybean meal demand for the world is going to come to the U.S. Well, it hasn't yet, and it probably won't until later on in the year, if it does. If it happens at all, it'll come more likely in the July-August timeframe, which is at the end of our marketing year. So that's something that we're going to have to wait on. We're going to wait to see it. And another reason for that is Argentina had a lot of large ending stocks. The farmers had plenty of grain. They're not selling their soybeans now either because their prices could go higher. They've got inflation, so they're not going to be marketing their soybeans as quick as as they normally would. Brazil had helped hold back a large supply of soybeans. So South America can meet a lot of demand. They also have the advantage that their crop has a higher protein value and a better value than the U.S. crop this year. So the exporters are going to South America to buy. And they're willing to pay more because of the better quality. So that's some advantages that still are driving demand to the South American market. This last week, today, USDA announced their weekly sales. We had nearly 2 billion bushel, or 2 million metric tons of soybeans sold last week. China bought a lot of them. They came back from their holiday, their New Year's holiday that they had it goes on for 2 weeks. They came back buying and made up for the losses that they had, or the cancellations they had during their holiday. So we'll see if the demand can continue. U.S. soybean yields. That's another big question. What are we looking at this year? I think the USDA's got 49 in their outlook meeting. They came up with like 49 bushel an acre. Likely, this is the red line there is trend yield. That one bubble up above there is the yield that we had last year. More likely, we're going to have a lower yield than we had last year. But the question then is going to come, how many acres do we have? Now, Allendale is doing a survey right now. Some of you may know Allendale. Some of you may have helped out already. If you haven't, go to www.allendale.com. Help us with the survey. It's through tomorrow. We've done the survey for 29 years. We've got a lot of the trade wondering when, waiting for Allendale's survey numbers because it has been highly followed. We ask your help in filling this out because we need your input in order to get an accurate number. And we would appreciate it. It's going to be released on the 14th at 10 o'clock in the morning. We're going to release it on Twitter live. So anybody that is a Twitter follower here, you can go on Twitter at 10 o'clock and you'll see a live release of the numbers. So, and we'll also be doing webinars so you can follow at later time as well. Big question then this year is how many bean acres are we going to plant? There's people out there touting that we're going to have 1-2 million more acres of soybeans because of the profitability of soybeans over corn. This chart is pending. The red line is the soybeans, the blue line is corn. Soybeans are more profitable than corn production. Especially with the yields that we've seen in the last couple of years. Last year especially, 70, 80, 90 bushel an acre soybeans. Can it happen again? I think the genetics in soybeans and you have to take your hat off to the soybean seed stock producers because of the excellence and the amount of soybeans that we can produce per acre. But the question is, will we plant that many more beans? I think in my opinion, we're probably where you're a 50-50 rotation, looking at profitability. We're probably not going to see that many more soybeans. The areas that will change is like North Dakota. They can flip-flop every year. They can flip-flop 4-5 million acres. If it's good weather in the spring, they're going to plant wheat. Especially the way wheat prices are right now, they know they can produce wheat. They've planted soybeans, they've planted corn, and they've had problems with diseases and various other production problems in soybean and wheat. And they planted corn, broken that cycle for a couple of years. They can go back to wheat now and get the same benefits that you get when you plant corn after soybeans. So North Dakota is going to be a big swing state when it comes to acreage and determination of how many acres that we really plant soybeans. Another factor in soybean demand is the crush. Now you'd expect if we're going to sell all this soybeans, and a lot of people believe that because of the loss in Argentina, that if they lost from 54 million tons to 48 million tons, that's going to amount to about 250 million bushel of soybeans, and all those soybean sales are going to come to the U.S. Not the case. There's other places that they can get it. I'm telling you about the storage that the U.S. or that Argentina and Brazil have. They may not come to the U.S. Maybe they come for half of it. So that only, with a 550 million carryover, you take half of that, you still have 450 or 425 to 450 million bushel ending stocks, which still is a huge amount. Crush is key to it. The USDA is projecting we should have about a 2.6% increase in crush over last year. Right now we're running at about a 1.6, so we're running behind on our crush levels. And a lot of that is because of demand. The biggest problem that we have is in exports. In this chart, you can see off to the right, the big bar, 466 million, 466 is at the top. We got 466 million bushel that we have to sell yet before the end of the year, the end of our marketing year. And as you can see, the rest of the bars, they're all less than that. So we've got record marketing sales of soybeans that we have got to make before the end of the marketing year. Now we've seen the USDA take 25 million off of that. So if you took 25 million off of 466, what's that give us? 437. Still above any year in marketings that we had to account. So likelihood is that we will still see an increase in ending stocks because of demand of soybeans, and most of that is because of our exports, unless we increase our exports here rather dramatically. And with Mr. Trump's speech this afternoon, who knows what that might be. With the tariff talk is supposed to come out at 2:30 this afternoon. We'll see what he says. If he carves out Mexico and Canada, everything is up in the air. Will China retaliate? Will they retaliate for soybeans, put a tariff on that? They may not put a tariff on it, but they might find contamination in soybeans or FM or whatever it might be. They have always a way to get even. So that's going to be extremely important as we move forward. This is just a balance sheet. USDA came out with 555. The middle column there, right down here, this was our projection, 554 for today's report. It came out at 555. I always think that the USDA is probably checking our emails and so forth, because they come out with sometimes the same numbers that we do. So I'd like to think that's the case, but not always. And this is next year's production. We're not raising soybean acres very much. We're only increasing soybean acres slightly. From last year we had 90 million, 90.1. We think it could be 90.2 basically. Not a lot of change. We don't see a lot of change in soybean acres, and we won't see a lot of change in corn either. But if we have an average crop at 48.8 bushel an acre, we could have ending stocks next year of 611 billion bushel. So when you take soybeans and you look at what the potential is based on the fundamentals, supply and demand, and you got a money flow situation that is very bullish because there's a lot of money on the sideline. There's a lot of money being repatriated, coming back into the U.S. So that money goes somewhere. There's money coming out of the stock market, potentially could go to agriculture, what we've seen in the last few months. How long will that continue? But when you're looking at fundamentals, it kind of deflates that excitement of how high do we go. Because all of one, some morning somebody's going to wake up and say, well, we've got all these soybeans, we don't need to be at this price. And if we have soybeans at this price, how many more soybeans will be planted based on that? Because you guys know that if you can make more money and you can make money, you're going to plant them. Why not? It makes sense. Well, this is our price outlook for soybeans. We think that we're in a period right now that could be very near the high. This is our projection here. This is for November beans. I think we had a projected high of around 1035. It went to had a high so far at 1047. And we'll probably see a little bit of a sell-off rally again in the summer because we're going to have a very, very sensitive market going into the summer because of weather. South American crop is going to be past us, but we know what happened there, so we remember that. Traders will remember that. So that could give us some volatility later on in the year. But can we wait before we sell our crop to do that? Because, as I said, as long as money flow is going up, that's great. If money flow decides to stop buying and start selling, that could change the whole attitude of the your financial situation. So I'm going to give you one trade idea today. The rest of there's a lot of ideas we've got, but you can call us and get the rest of them because we don't have that much time to go through the different scenarios for everybody. This one I think is a good strategy, something that everybody should be doing. And that is, it's an option, a three-way option spread. And many of you have not traded a lot of options. Want to trade options, trade them once, because they should probably ask the question, how many's lost money trading options? Everybody raised their hand because we have lost money trading options. But the whole strategy there is we want to change that trend. This trend is a strategy to protect your bottom line. It's going to help Tim at the bank feel a lot better about the loan because you've got some protection. What we're doing here is we're buying a $10.20 put. We're buying a $10.20 put, and we're going to sell a $9.20 put. So we're paying, let's say, I don't know what the premium might be, and then we're going to sell a $11 call. And we're going to do all of that for zero cost, meaning that you don't have to put up any money. It's not going to cost you anything if the market goes down, if it goes up, it's not costing you anything. So what I'm saying there is you are selling your cash, you're selling futures at expiration for $10.20. So this fall, October 26th or whatever date, the last trading day is for November options. If it is at $9.20, you've sold beans at $10.20, you make $1. If it goes up, let's say the bean prices go up, you now are going to increase your sale price, or can increase your sale price, all the way up to $11. And as we showed in the fundamentals, which we happen to think will take effect at some point in time, chances of $11 are probably not real great. How many of you would love to sell soybeans at $11 now? A lot of you. So if the market goes up, the problem with this strategy, I say a problem because nobody wants to meet margin calls. But when you have a strategy like this, if the market goes up, there will be a margin call, some percentage of change because you're short an $11 call. So that means if the prices go to, and it'll change, there's no way for you to predict the amount of margin call. It'll be some portion of the underlying futures contract, but it's minimizing your margin call. And that's what we try to do. And you've got a floor at $10.20. You have zero cost in it. Because a lot of options, with the options that you traded in the past and you lost money on, let's say you bought a put and you paid 20 cents for it, you've now lost 20 cents a bushel or $1,000 on a 5,000 bushel contract. This you have a 5,000 bushel contract and you have zero cost. That doesn't mean there isn't a margin requirement though. But at the end of the game, if you stay with it, the beans close below $11 on October 26th, you will have zero cost, other than the commissions, which might be, you might, today, actually yesterday I looked and you could do it for a penny credit, which means they're paying you a penny to do this, which helps offset some of the commissions. So this is what it looks like in the chart. Point here is, that I'd like to make is that the right now we got beans above that 1035 or 1020 area, very close to 1020, and if the market starts to fall, it could fall rather quickly. So there is a good opportunity and good reason to do something like this. I'd be happy to talk to you more about it. Let's look at corn for a bit here. And corn, we've got the ending stocks. They lowered ending stocks on corn today, by the way, about 200 million bushel, I think it was. Well, they went from, the USDA had 2.352 million bushel carryover. Now we've got 2.127 million carryover. And what they did there, they raised exports, they raised feed usage, which we thought feed usage was needed to go up anyway. We've got more cattle, more hogs, more chickens, and yet on the last quarterly stocks report, they did give us a lot of feed usage, and they finally put that into the balance sheet, which lowered the corn ending stocks. But you have to remember, we still have over 2.1 billion bushel of corn at the end of this year is what they're projecting right now. The exports on corn, they look good. We're running right on average with targeted, actually with the exports that they announced today, we're running above the average of what we should be selling. We're at 79% sold versus a 75% is what our 5-year average is for sales of the U.S. target, USDA target. So we're doing very well on exports on corn. Ethanol production, we are doing very well also. The USDA says we need to increase by 1.6%, and we're above that line, as you can see on this chart. Corn for ethanol is above where the USDA. So they, and actually I think they did increase ethanol usage by about 25 million bushels today. Ethanol demand, this is where the exciting thing for corn comes in. Ethanol demand, Brazil increased their mandate that they want more ethanol in their fuel mix. So therefore, they need to get ethanol. They had a poor sugar crop a year ago. Now they got to find ethanol somewhere. So they come to the U.S. and buy it. You can see and China is also a big buyer of ethanol. Another story that many people are talking about, a reason why the corn demand and corn prices are going to go to $6 again, is because China is changing their mandate to have more ethanol in their Clean Air Act, basically, to clean up the pollution that they have in their cities by using more ethanol. But, you know, that's been talked. We haven't seen any fact about that at all. And if it happens, it's going to happen over a period of time. It's not going to happen this year, I don't think. It's more like a 2019, 2020 type action where they may come back in and get more, buy more fuel from us, ethanol, and corn, produce ethanol. They've got most of the corn ending stocks in the world is owned by China. And they need to clean them up, they need to get rid of them because it's like we had in the 80s, 87, 88, we had to get rid of our stocks because it was going out of condition. They've got the same problem there, so they figured, let's pump up, let's make some ethanol, and they can do it very quickly over there in a very big way also. Here's a balance sheet for corn. Not a lot to talk about here. We know we've got a plentiful supply. Demand is where we have to see increases, and that comes from feed usage, ethanol. But the ethanol industry in the U.S. is a mature industry. So how much more can we use, how much more corn can we use for ethanol production? That's a good question. So it might be really minimal in the whole piece of the pie. But I put the number in here for what USDA came up with today, 21.27, changed their ending stocks. This was Allendale's number, so they didn't copy us on this one. But we were higher than what, we didn't think there'd be much change in corn, but that's why we've got the USDA to keep us going, keep us on edge. Planted acreage is, I think, a big factor. And this chart kind of gives you an idea of the acres that are planted each year. And you can see that there's huge variations in the amount of acres that we plant. This year, not much change. The USDA came out with their estimates on their Ag Outlook here about 2 weeks ago, I guess, now. So not much change in the top three commodities, corn, wheat, and soybeans, but your other products have seen increases in acres. But the total acres producing are going to still be very close to what they were a year ago. I put this chart up here just to show you how prices impact the planted acreage of corn. Say, well, we're going to keep it about the same, we're going to stay at a 50-50 rotation, but when there's profitability for corn, we plant more corn. When there's not, we cut back on it. So I think this year a real key number to price outlooks and supply will be the number of acres that actually are planted. We've got that number, and that's why we're doing a survey, and that number comes up on the 31st of March. So we'll see what USDA gives us there. Our numbers, these are the projections that we believe are likely. We'll see just under 90 million acres for corn. This is roughly 90 million acres for soybeans, a lot more soybeans than corn for the first time in a long time. And wheat acres will probably be a little bit higher than last year. And these are preliminary numbers. This has nothing to do with any early numbers we've got on our survey. These are statistical numbers that our chief economist, Rich Nelson, has come up with in his projections. Profitability, where some of the switching might occur. Some of that switching might occur in Illinois, Indiana, where they have planted a lot of corn on corn for a lot of years. We're hearing guys that will be going to soybeans just because of input costs, because of the production that they can get off of the corn after soybeans, and we think that there could be some switching there. But again, North Dakota, South Dakota, northern Minnesota, those areas switch a lot. And North Dakota is probably the biggest one. It's going to depend on the spring up there. They've got a wet spring. I mean, they could have 6 million acres prevented planting because they can't get it planted. They may have 1 million prevented planting if it's dry. And water in North Dakota in the spring, there's not a lot of snow cover up there, so chances are they probably won't have a lot of flooding. Maybe they can get in early. If they get in early with the price of Minneapolis wheat, they're going to probably plant wheat because they know they can get a good crop. So that's going to be a big determining factor as we go forward here. The corn, these numbers, if we look at, you'll have to take the couple million acres off here, but this line we always look at is our average. We have an average crop, 173.7. I think the USDA's using 174 as their yield, their trend yield this year. The thing that you got to realize here, though, if you take 10 bushel an acre off, go to 163, you still come up with about a 119. Take a 125 off of there, you maybe at 118, you still have plenty of corn to go around. But certainly it would be a reason, if we got 10 bushel an acre drop in corn, it would be a reason for us to see corn prices move higher for a period of time. Our price outlook for July corn, we think we're getting very close to and have seen our low in here. We are friendly corn, but not bullish corn by any means. We think corn can rally because of the demand, because the way the funds have been, and even at long 100,000 contracts of corn, that's not a lot of corn. They could be long 150 to 250,000 corn and still be friendly there. But we think corn, the old crop corn, because of demand, could peak out sometime in April and May as we get crop planted. The other thing is we've seen a lot of corn by producers sold here at the end of February because of basis contracts and other contracts that you were tied into. Some of you might have been, maybe everybody that is not here did that. But then we're going to hold on to the rest of it, see what we've got. We've got bids, base, storage out there. Just don't hold on too long. Basis gets good, sell it. You can always re-own it on the board. And that's something that you really need to look at this year because the guys that have done basis contracts we had producers call us at the end of February. And this is where I pulled my hair out. They said, well, we can do a basis contract. We're gonna roll that. They had a basis contract off of March. We're gonna roll that to the July. Why would you do that? So you gotta, I don't know what the basis might have been, 20 under the March, or 40 under the March if it was. And now you're gonna roll it to July, so you're gonna roll, you take the carry off of or add that to your basis, and now you're at 50 under the July. Why would you be 50 under July? I mean, it's better off to sell the cash, own it on the board if you want to own it, do an option strategies. There's so many other ways to free up cash to help take care of Tim's needs, to get that loan paid off, and keep your bankers happy. That's the opportunities that are there right now, rather than holding on to the corn, holding on to these contracts. If I was in a basis contract, I would get out of it, because another part of it is that if you've got a basis contract, the elevator's holding 30% of your money. Here we hold 5% of your money in the futures market, and you got less risk. So, or you got the same amount of risk in price if you're going futures versus the basis contract. But you're holding a lot more money than the elevator is. So this is our price outlook. So what I'm really showing you here, the key is if we've got this July corn $4 to $4.10, we're worried about price more than we are time. And if we got July corn up at the $4 to $4.05, $4.10 area, we would certainly look to be a seller there and take advantage of the opportunity the market has given us. December corn, we think that we're in a time frame right now where December corn's getting high enough, and one of those reasons are is that we're at a time here where we're going to decide should we plant more corn, should we plant beans. And you know, many of you guys I know are in a 50-50 ratio, and you're going to stay that way, and that's good. But some of these outside areas, Illinois, they're going to decide if corn's over $4, they're going to plant corn instead of beans. Do we need more corn acres? I don't know. That's going to be the the question, depending on the weather. One strategy for corn for you. And this is a strategy that you put an order in today because you're not going to get it filled today. But what we want to do is buy a 420 put in the December contract, sell a 470 call, and we want to keep our downside open. So we're doing a synthetic futures position, as the trade calls it, but we're going to sell and protect our corn, December corn, at 420. We can't do that today, but it's a place where you want to get your order placed so you can. And we can do that for about 10 cents. We want to do it for 10 cents. I think it's right now trading at about 16 cents. So it's going to take some time. We need to get corn prices, December corn, to 420. Do we think it can go there? Yes, we do. We actually think it can go higher than that. So, but you have to have your option orders in and make sure they get filled. So to recap here, what you need to do is corn, we're giving you the idea of buying a 420 put, selling a call, and the soybeans, do the three-way strategy. I think I would do that today, or put an order in at even money or even a credit, and let the market come to you right now. And we think that is definitely an opportunity. So what I want to leave you with today is, what do you do when you leave here? Say, yeah, all had a good story there. It was a story that is wrong, whatever, right. Whatever you do, agree with me. But the thing that you need to do right now is I want you to do is take action. You need to get to your elevator, to your broker, put your orders in, because with the volatility that we've got, there's orders that I've had in for customers that we get filled overnight, and we sell it at the high of the night session because we had an order there. So get your orders in. Place the orders. I can repeat. Do I want to sell it today as a top end? I don't know. But I do know when the funds roll over, we better have our grain sold, because when they're done, it's going to be down sharply, and it'll be very quick. And then it says, well, I'll sell it when it turns. It's the old adage, how do you catch a falling knife? I'll get your hand cut by the handle, right? You young guys know that over here. So we want you to help. We need your help on the planted acreage survey, and you can reach that by www.allendale.com. Just follow the guidelines there, and if you got any questions, don't hesitate to give us a call. So I appreciate Hills Bank for having me, and thank you for listening, and we wish everybody a very successful year, safe year farming.